Hello and welcome to today's Smartkarma webinar in collaboration with ASEAN Exchanges. I'm your host, Maliha Hadi. Today, I'm excited to welcome Smartkarma analyst Dr. Manishi Raychaudhuri for an exciting chat on the ASEAN region's capital markets. Manishi possesses nearly 3 decades of experience analyzing Asian equities, having previously worked in senior leadership roles across BNP Paribas and UBS. He will be discussing his outlook on the ASEAN 6, as well as share insights on sector trends, policy shifts, and future risks impacting markets in the region. Manishi, thank you for being with us today.
Thank you very much, Maliha, and thanks to our audience on the Smartkarma and ASEAN 6 platforms. Just a bit of introduction. I am the founder and CEO of Emmer Capital Partners, and we are based in Hong Kong, and the company is a financial advisory firm. I spent, as Maliha said, almost 3 decades as Asia Pacific Head of Equity Research for BNP Paribas, also the Asian Equities Strategist. And prior to that, about 9 years, almost a decade with UBS, and even before that with ICICI Securities when I was back in India. So it's a long experience, not across different companies, but also across different locations in the region. Today, what we're going to discuss is basically the 6 largest markets in ASEAN, popularly called the ASEAN 6. They're both the structures of their financial markets, equity and fixed income, and the macro drivers. In fact, that's where I'm going to spend a lot more time on the macro drivers and the risks that they face in the current turbulent environment. And finally, on the outlooks on the asset classes, equity, fixed income, and currency. So we will dive into this. I would request Maliha to share the presentation that we have for this purpose. Maliha, over to you.
Thank you, Manishi. I'll do so. Just before we begin, a bit of standard housekeeping. We will be taking live Q&A for this webinar, so I would request our attendees to post their questions in the Q&A tab at the bottom of their screens. Please also refrain from resharing the contents of this webinar without express permission. A recording will be available afterwards on the registration page and will also be sent out to all attendees. So now, Manishi, over to you.
Excellent. Thank you. Thank you, Maliha. So, well, the drivers, policies, and risks. If we go over to the next page, we have a quick summary of what we are going to discuss. And we will start with the market structures in each of these markets, equity and fixed income. And so if we could go over to the next page, we will start with Singapore. This is, possibly one of the most important markets in ASEAN because it is not only limited to issuances of companies limited to Singapore who are located and domiciled in Singapore, but also of fixed income securities in particular from across the world. The equity market is 617 listed companies, 620 billion in total market cap, average daily turnover 850 million. The equity market is dominated by financials, and by the way, in the pie chart, what you see as financials, almost 60%. It also includes properties and REITs, which are a staple diet in the Singapore market. The second largest are communications, telecom companies like Singapore Telecom, etc. Interestingly, this is a market that's been dominated by dividend yields. If you look at how the equity market has behaved over the past decade, it has been virtually flat, over a decade. But the total return over the last 10 years is about 49.1%. And that's a similar pattern, whichever time horizon you choose, 1 year, 3 years, 5 years, or 10 years. The average dividend yield is in the range of 5 to 6%. So this is basically a high dividend yield market, thanks to the REITs, the banks, and some of the telecom companies. Over to fixed income, the bond yields have been declining. Singapore is highly rated. It's a AAA rated market, the sovereign bonds. Government debt issuances have been in the range of 40 to 50, about 40 to 50 billion per year. And the total market size is 3.4 trillion. Unlike most of the other ASEAN markets, Singapore enjoys issuances from all across the world and pretty much all across the emerging market universe. From 56 countries, corporate and government bonds are listed there. If we go over to the next page, we now talk about Indonesia. It's the largest economy in ASEAN. And in terms of equity market size, it's the second largest market, 610 billion in market cap, 943 stocks listed. It is also somewhat similar to Singapore in terms of the market structure. Finance, 30%, energy is about 16%, and non-energy, other materials are about 10%. So these are the dominant sectors, which are about 55 to 60% of the total equity market. It's an active IPO or new equity issuance market, though the kind of stocks that are listed, they're mostly of, what one would characterize as mid and small cap. There were 40 new listings in 2024, and they raised about 2.3 billion. So, on an average, about $60 million per issue size. In terms of the fixed income market size, 409 billion, that's the total size. So you would notice the contrast from Singapore. It's mostly Indonesian companies, both government bonds, corporate and government bonds, and sukuks, the Sharia compliant bonds, which are listed here. Again, close to about 50 to 60 billion dollars raised in the bond market every year. Bond yields have been flat. It's the reasonably highly rated market, about BB. Sovereign triple B, actually, from S&P, and with a stable outlook. If we move to the next slide on Malaysia, here the pattern is similar. The equity market is again dominated by financials, process industries, utilities. These three sectors and communications, that's the fourth largest. These four sectors form almost 60% of the market. In a sense, one commonality, one common thread across these markets is that over the last 10 years, these equity markets have largely been flat. So it's over the last maybe 3 to 5 years, we have seen some returns being generated, partly because of the COVID lows that were touched in 2020 and 2021. This is also an active IPO market, somewhat smaller in size compared to Indonesia. In 2024, there was about 1.6 billion raised from 55 new listings. So the character of these IPOs are similar. They would possibly be categorized as small and mid caps. It is the largest sukuk market in the world. If you look at the fixed income market, it's about 471 billion in size, slightly larger than Indonesia. The largest sukuk market in the world, credit rating of A with a stable outlook, so slightly highly rated than Indonesia. 10-year government bonds have been flat over the last 2 years. Partly one of the reasons is that Malaysia has not really cut the benchmark policy interest rates, unlike many of the other Southeast Asian markets. If we move over to the next slide, Thailand. So again, the equity market, the common thread that runs across the equity market is the structure. So we have about 450 billion, that's the total market size, slightly lower than Indonesia, Singapore, and similar to Malaysia. 860 stocks listed. So that's actually the third largest after Malaysia, Indonesia, and here comes Thailand with the third largest number of stocks listed. The structure of the market is similar. Financials, utilities, energy, and communications. These four sectors form almost about 60 to 65% of the market. On the fixed income side, 10-year bond yields have been declining in line with very low CPI, a very low inflation in the Thailand market. The total bond market size, again, slightly higher than both Indonesia and Malaysia, about 500 billion US dollars. Government bonds account for 60% of the total market. Again, similar to the other two markets, BBB plus rating, that's closer to Indonesia actually, by S&P with a stable outlook. As we would go on to see later on that as far as fixed income is concerned, the stability in these markets actually come from the fact that they have not been profligate. The governments have not really raised huge amount of debt. There's not much of public debt in these markets. And Indonesia and Thailand actually have a limit uh, to which their government debt to GDP can go. So I think it's this fiscal discipline on the part of the governments which leads to this relative stability on the part of this as far as the sovereign credit rating is concerned. Let's go to the next page. That's Philippines, a relatively smaller market, 283 stocks listed, 350 billion. But the structural similarities here also. Finance dominates, and this is a common thread across entire ASEAN. It's the financial sector. If one combines real estate and REITs with them, that actually dominates across all the markets. In case of Philippines, this dominance is actually eye-catching. You have 47% in financials, 11% in retail, and if you include consumer staples and utilities, that's about 70 to almost 75 to 80% of the total market are in these four sectors. As far as the fixed income market is concerned, again, Philippines 10-year bond yield is relatively higher, similar to Indonesia. It's been flat. The total bond market size is about half the other markets, 230 billion, and it's largely a government bond market. About 90% of the market is government bond. Interestingly, Philippines is also a sustainable bond market. So, in fact, it's possibly the second largest sustainable bond market after Singapore, with about $11 billion of sustainable green bonds being issued here. If we go to the last market, that's Vietnam. Again, we have the market size, about 722 stocks listed, 230 billion. So Vietnam is actually the only equity market which is not part of the MSCI emerging market universe. All the other five, Singapore is a developed market, but the other four, Indonesia, Malaysia, Thailand, and Philippines, are part of the emerging market index in MSCI. Vietnam is part of the frontier markets. Market structure, again, similar. Financials, real estate, consumer staples, and materials, they form more than 80% of the total market. The 10-year bond yield has been declining, barring a spike in 21-22 on account of the inflation spike that we saw around that time. The total outstanding local currency bonds, and this is essentially a local currency bond market, is about 150 billion. And as with the most of the ASEAN markets, it's a government bond dominated market. 70% of the market is in government bonds. Interestingly, something I didn't mention, and this is a point of difference as far as Vietnam is concerned, it has two stock exchanges. So this is like somewhat similar to China or India. So you have the Ho Chi Minh Stock Exchanges focusing on the large cap companies, and the Hanoi Stock Exchange catering to the small cap and derivatives trading. Great. So that is as far as the market structures are concerned. We will now spend a little bit of time, in fact, considerably more time on the macro drivers. First of all, let's take a look at how these markets, how these economies stack up, in terms of how large the total ASEAN economies are and which are the relatively larger markets and at what rates they have been growing over the past decade. If we turn to the next page, so there in total about 3.6% of global GDP. So if I look at, it's about $3 trillion US dollars. I think it would be somewhere in the range of 3 to 3.5% now. It's a total global GDP is in the range of 90 to 100 or so. The ASEAN 6 put together has been growing in the range of about 3.8%. That's the real GDP growth. So in this slide, you will see the subscripts N and R. N stands for nominal growth, R stands for real growth. So Indonesia's real growth. Indonesia, by the way, is the largest economy in this universe. So, about the total size of these economies put together is about 3 trillion. So almost half of this, 1.4 trillion, is Indonesia. The next three largest, Singapore, Thailand, and Philippines. These three are the same. Put together, they are the same size as Indonesia, about 1.4 trillion. It's not surprising. Indonesia is also the most dense, highly populated. It's about 280 million people. That's the population. Also, another interesting aspect of Indonesia is that that's the only economy which currently has the so-called demographic dividend. It has an increasing workforce, which is actually rare to find in the whole of Asia. China doesn't have it. Japan, Korea, and other North Asian markets, the populations have been declining for quite a few years now, of late, even in China. The only other large economy in Asia which has a demographic dividend or an increasing working population is India. Great. Let's take a look at the next slide, which is on consumption and investment. So the way we will go about it is we will think of the structure of each economy. After all, GDP is C plus I plus G plus X minus M. It's consumption, private consumption, plus investments, plus government consumption and net exports. So we shall look at each of these three components, private consumption, investments, and net exports, to determine what's the structure of these economies. The ASEAN economies, barring Singapore, are largely private consumption driven. So you have consumption to GDP, Philippines at 676%, Malaysia at 61%, Thailand and Vietnam in the mid to late 50s, Indonesia about 54%. The only exception is Singapore, which is largely export dependent, as we shall see. The exports to GDP there are in double digits. If I look at the consumption growth, actually currently of late, if I look at 23 and 24, Singapore's consumption growth has been the strongest. The other parts of ASEAN are actually kind of closely bunched together in the range of about 3 to 5%. If you look at investments, that's about 29 to 30% for Indonesia and Vietnam, and in the early 20s for Malaysia, Thailand, and Singapore, about 21 to 22%, with Philippines somewhere in the middle of this range. The strongest growth in investments is likely to come in Malaysia, partly because of various government programs that we shall discuss immediately after this. Some of that is actually spilling over into Singapore as well, because there's a degree of commonality, there's a degree of collaboration or regional cooperation that's actually happening between these countries. Let's go to the next slide. This is the external trade structure. So we looked at C&I, private consumption and investments. Now we shall look at X minus M, or net exports. Now notice here that there are two kinds of exports. There's merchandise exports and service exports. So most of these countries, in fact, Indonesia, Malaysia, and Vietnam, these three are actually merchandise exporters. So that's why there you have, take Indonesia, for example, the trade balance is high. It's in the range of about 2 to 3% of GDP. But the current account balance, which is arrived at after adding services export or deficit to the trade balance, that is negative for Indonesia. So Indonesia has a merchandise trade surplus, but a services deficit. So Indonesia, Malaysia, and Vietnam, they're service importers, but goods exporters. And this is something very important to remember, because in the present state of affairs that we are seeing, with tariffs being imposed, the tariffs are being imposed on merchandise trade, not on services. So these countries, particularly the countries which are very large merchandise exporters, they could be at risk from the regime that that's basically ruling the world today. Yeah, and this is something we shall discuss later on. Singapore. Singapore has a surplus both in merchandise trade and services. This is an exception as far as this region is concerned. Thailand is on the other extreme. So Thailand has a merchandise trade deficit. It is a goods importer, but a large services exporter thanks to a thriving tourism business over there, which is not only tourism, but also healthcare tourism. It's this hospital chains, which are large centers for overseas patients. Philippines has a merchandise trade deficit and a services surplus, but the services surplus is inadequate to neutralize the merchandise trade deficit. So that's why Philippines has a current account deficit, unlike Thailand. And as we all know, for Philippines, the service sector surplus really comes from the IT services, not so much the IT services, but so much more so the BPO, the business process outsourcing, the call centers, and so on. Great. If we now move over to the next page, and this is something that we shall talk about in some detail, this specific for policy focus in ASEAN countries. There's a common thread running across these. If you look at the bullet points in each of these, you will see that almost all these countries are actually in the process of providing some degree of stimulus, mostly, partly fiscal and partly monetary. And the focus seems to be on infrastructure creation. It can be transport infrastructure, it can be other kind of digital infrastructure. Indonesia, in a sense, stands out because it has a lot of mineral reserves, particularly nickel, which are used for battery manufacturing, for other areas in electric vehicles. And what Indonesia is now trying to do, apart from expanding its government debt, is also downstreaming. So not just exporting the minerals, but also adding value to the minerals and exporting the value-added product. Thailand, there's a boost to tourism. Tourism is almost 20% of GDP for Thailand. There's a continued expansion of visa-free entry schemes. And there's a specific program to support the SMEs, the small and medium enterprises, particularly those in semiconductors and data centers. Malaysia, they're trying to raise resources through an introduction of dividend tax for high-income individuals. And interestingly, one of the most important infrastructure initiatives is the Johor-Singapore Special Economic Zone. And this is something we discuss in the context of Singapore also. This is a 3,500 square kilometer area and targeted at enhancing regional cooperation and boost diverse sectors like data centers, electronic, tourism, renewable energy, and so on. Philippines, again, targeting 10% increase in government spending, key allocations in education, public works, and military modernization. For Vietnam, there's a 2% reduction in value-added tax and the deferrals for tax and rent payment to support businesses. Almost all these countries, they have programs for accelerating digital transformation, aiming for the digital economy to contribute more. In case of Vietnam, they're targeting about 25% of GDP by 2025. So this is something we shall keep in mind when we look at the forecast. But before that, actually, when we go to the next page, we will see how inflation and interest rates are panning out in these countries. Actually, whole of ASEAN, in fact, I can possibly extend that argument and say whole of Asia has actually seen quite low inflation over the past 2 to 3 years. In fact, unlike the developed economies, which had a bout of high inflation, and like the United States, they had core CPI inflation in the range of 4 to 6%. That has not been the case for ASEAN. As you would notice in these top two charts, inflation, this is CPI, or the Consumer Price Index, inflation has been rapidly declining. It has moved up slightly in case of Thailand, but it is still close to zero, in the range of possibly 0 to 1%. So the CPIs are, in fact, Indonesia is another country which is close to negative inflation, close to deflation right now. I would say that as a consequence of this, most of these countries, most of these countries have a lot of space for cutting interest rates. They haven't really cut interest rates too much. It's only Indonesia, Philippines, and to some extent Thailand, which have started doing this over past maybe 3 to 6 months. But they have a lot of room for monetary policy stimulus going forward. If we move over to the next slide, this monetary and fiscal policy space is what we discuss. The real policy rates in the ASEAN economies are actually quite high. Indonesia, 4.75%, Philippines, 3.95%. Most central banks target to have the real policy rates in the range of 1 to 3%. So that would imply that these countries have significant room to cut down interest rates. That may not be the case for Thailand, possibly one more interest rate cut this year. If you look at fiscal policy, the governments are not really highly indebted. So in case of Indonesia, the public debt, the government debt is about 39% of GDP. In case of Thailand and Malaysia, in the range of 55 to 65%. Singapore, of course, is higher. They're not really talking about much of fiscal action at this point of time. But these four ASEAN markets, they do have space to provide fiscal stimulus. They have historically been extremely fiscally disciplined. Indonesia has a limit of 60%, beyond which the debt to GDP is not allowed to expand. For Thailand, that limit is 70%, but they still have significant headrooms to go up to that level. The currencies have been a bit of a concern, particularly for Indonesia and till last year for Malaysia also. But thanks to a broad-based, dollar depreciation this year, we are actually beginning to see emerging market currencies, including the ASEAN currencies, actually move up this year, right from around mid-January. As we will go on to see, apart from, I think, Indonesia and Vietnam, every other ASEAN currency has actually appreciated. Great. Now let's come to the forecasts, and these forecasts are from IMF. Going to this slide, where you will see that the forecasts from the IMF World Economic Outlook, they have again one common pattern. There are three countries which are Thailand, Malaysia, and Vietnam. Thailand, Malaysia, Vietnam. These three countries are actually likely to have a declining growth, according to IMF, over the next 2 years, 25 and 26. Before recovering in 27. But the other two, that is Philippines and Indonesia, the decline in 25 and 26 is not really much. They're almost flat. And we shall see why. Because these countries, Indonesia and Philippines, are not really big exporters. But the other three, Vietnam, Malaysia, and Thailand, their exports to GDP ratio are a lot larger, and therefore they face the risk that's arising from trade tensions. Otherwise, the growth drivers are really, consumption driven by tourism and other private consumption in Thailand. In case of Indonesia, is infrastructure investments, similar for Malaysia. I think for Vietnam, it's also some kind of the free trade agreements that they have struck, particularly from the EU, trying to neutralize the impact from that they're seeing from the United States. Singapore, to some extent, is aligned with Malaysia. I think the JSSEZ, the Johor Singapore SEZ, would be a significant driver for regional cooperation and connectivity. Let's take a look at the per capita GDP and employment forecasts. The per capita GDP are likely to rise, and this is nominal economic growth divided by the population. They're likely to rise in the range of about 6 to 7%, particularly in Philippines, Indonesia, and Vietnam. I mean, those three are, kind of bunched at the top. Relatively low growth, kind of stable growth in Singapore and Thailand. Unemployment rates are not forecast to change. Not forecast to change in the foreseeable time horizon. They would remain relatively high for Indonesia and Philippines, but much lower for the rest of the region, rest of ASEAN. Great. So we have pretty much looked at the economies. It's time to take a look at the risks that these economies face. So these risks arise from trade turmoil, potential deflation, and some degree of domestic political instability, which we have seen, particularly in Thailand and Indonesia. But it's actually the first two which we shall spend some time on, which are possibly the most important, especially in the context of what's happening today. So if we go over to the next slide, this is what really explains what is possibly the biggest risk facing the ASEAN region. The ASEAN region in general is a large exporter. This is something that we saw earlier. If you look at Vietnam, Singapore, Malaysia, their exports to GDP are almost about 80 to 95%. 78% for Malaysia to 94% for Vietnam. On the other hand, Indonesia and Philippines are relatively less export intensive. They're in the range of about 15 to 19%. These are more domestic economies and therefore possibly relatively free from the kind of the trade turmoil or the tariff turmoil that we're seeing now. One needs to look at the exports to the United States for these countries. There again, it's a similar picture. Indonesia and Philippines, their exports to the US are about 2 to 2.5% of GDP, while for Vietnam, Thailand, Malaysia, that's a lot higher. Malaysia and Thailand about 10 to 10.5%. For Vietnam, it's about 29.6%, almost 30%. And it's kind of ironic that it's these countries that have been slapped with the highest, the reciprocal tariffs. It's 46% for Vietnam, about, I think, 32 to 36% for Thailand and Malaysia and so on. Right now, they're in abeyance. Right now, they've been postponed till early July. And the best outcome for these countries is to strike bilateral trade agreements with the United States till these reciprocal tariffs remain postponed. But there's something else that's also happening. The biggest giant in this region is China. And China is, as you know, they have a trade surplus of about $1 trillion every year, last year and the year before. And this huge exports are now being questioned by the United States, by Europe, and that's why China will have to export somewhere else. And interestingly, this is something that China has actually been doing. If you look at the bottom right-hand side chart, China's exports to the United States have been declining from around 20 to 21%. Now it's down to less than 15%. Into Europe, it was about 17% around 2019. It's now down to about 14.5%. But China's exports to ASEAN has been increasing over the past 15 years. China's exports to ASEAN is now higher than their export to the United States and Europe. This is something that the ASEAN region would have to be a bit careful about because it has the potential to, number one, increase competition drastically for the companies in this region, number one, and also to export deflation. as we know that China is in deflation right now, the prices are coming down. And if the low-priced, low-cost export kind of spills over in a much more aggressive fashion to ASEAN, then it's something that these ASEAN economies will have to contend with. So these are the twin risks that I would point out as far as the ASEAN economies are concerned. Great. Let's quickly move on now to the last part of the presentation, outlook on the asset classes, outlook on equity, fixed income, and currency. First, we'll start with equity on the next page. If I look at the earnings growth, and this is key to understanding how equities would perform, Asia ex Japan, that is basically developing Asia, the EPS growth in 25, 26, 27 are in the mid-teens. They're in the range of 15 to 16.5%. ASEAN has kind of a broad range. So at the lower end of the range, you have high single-digit growth, like you have Malaysia or or Indonesia. They're in early single-digit kind of growth over 25 and 26. So is Singapore, actually. In some of the other markets like Philippines and Thailand, there's a strong divergence between 25 and 26, very strong growth in 25 because of the low base that had been created over the past 2 years, then moderating down to about, kind of high single digits by 26. So if I look at his CAGR, it kind of varies between high single digits to mid-teens. The cheapest markets, if I do a growth adjustment, that I look at the price earnings to growth multiples, they are Thailand and Indonesia. In fact, Indonesia is trading at a PEG less than 1, which is normally treated as some kind of a thumb rule for for designating a market as attractively valued. We don't have similar growth estimates for Vietnam because, as I said, it's not part of the emerging market universe. But the GDP growth is in the range of 5%. Vietnam is again dominated by the banks, which are essentially domestically focused. So that should translate to healthy corporate earnings growth, I would think, in the range of early to mid double digits over there. Great. Now, if we look at the next thing, that this is how earnings estimates are moving. So today's earnings estimates are in the range of, say, early teens, or rather the single digit to mid-teens kind of growth. But these earnings estimates are constantly changing. We are seeing that there's a mild upward revision in these earnings estimates in Singapore, Thailand, and a slightly more aggressive revision in Philippines, which means that these markets, some of these markets which may appear expensive tomorrow, may appear expensive today, but it can appear inexpensive or cheap tomorrow as the earnings estimates move up. This is something that we track very closely. We call this earnings inflections. And some of these markets like Thailand and Philippines are actually seeing upward earnings inflections, which are of great interest to the investors. Great. Let me move over to the flows on the next page. ASEAN is generally under-owned. It has been sold down heavily by the foreign institutional investors over the past 1 to 2 years. In fact, if you look at Thailand, FIIs have sold about 10.2 billion right from early 2023. I think except for 1 month, in each and every month, Thailand has been sold down. Indonesia has also been sold, not to that extent. So over the past 6 to 8 months, it's been sold down about 2 billion. I think that's one of the reasons why we're seeing these, the rate of sales coming down a bit. So incrementally, I think investors, the foreign investors, are beginning to become aware that this is a highly sold down, highly under-owned space. And if we do have earnings estimates moving up in some of these markets, if we have relatively low risk in some of these markets, like Indonesia, Philippines, or Thailand, as we saw, there is a possibility of those flows coming back in. Great. Now, if we move to fixed income, there are some markets which have high yields. In fact, if one looks at Indonesia or Philippines, they have significantly higher yield than the United States, which obviously for for an overseas investor makes some of these markets relatively attractive. But of course, one has to take a look at the sovereign ratings as well. It is understandable that the markets with low yields like Singapore or Malaysia, they have higher ratings. So Singapore is AAA stable, Malaysia is A stable. But it also means that there is a significant yield hunting opportunity in some pockets of ASEAN. Now, if I look at the currencies, in general, we are in an environment of dollar depreciation. In fact, the most recent GDP growth revisions that the IMF has done, it has cut down US growth a lot more than Asia or other parts of emerging markets. So we would expect the ASEAN currencies to remain relatively stable and maybe appreciate slightly from here. Till date, in the first 4 months of the year, all the ASEAN currencies, barring Indonesia and Vietnam, have appreciated. I think this is partly driven by what they have done in their monetary and fiscal policies. But this relatively strong currency also opens up a lot of policy space for them. They don't really have to worry too much about their currencies depreciating before engaging in monetary or fiscal stimulus, which they may have to give in an environment of trade slowing down. So that is, in a nutshell, what we have to say about the asset class outlook. That's about it from me, and I will wait for any questions that you may have.
Thank you very much, Manishi. That was great. And it was a very interesting presentation. As you mentioned at the top, you can now send me your questions for our speaker using the Q&A button on your Zoom app. Manishi, I see we actually have a question in the audience right now from an anonymous attendee. The question is, how would you think about ASEAN currencies with the threat of tariffs? That is in the context of tariffs.
Right. Well, obviously, whenever tariff is imposed on any economy, one obvious response, and we have seen this earlier in 2018 during Tariff War 1, one obvious response is to depreciate its currency so that the price of the commodity that it is exporting to the United States, that is, sort of the effect of the tariff is neutralized. So if, let's say, the tariff is an additional 10%, if the currency depreciates by 10%, there is no net impact on the price at the destination. As of now, in whole of Asia, we have seen only this in China. So the Chinese RMB has depreciated a bit. The other currencies have been relatively stable. So even though tariffs have been imposed, and very large tariffs, the reciprocal tariffs on Vietnam or Indonesia or Malaysia, their currencies have been relatively stable. The countries have not really reacted in the way that they could to neutralize the prices. I think, on the whole, I mean, if it would depend on what kind of deals that they're able to eke out with the United States. But if we do have over the next 1 or 2 quarters some semblance of some bilateral trade agreements with the United States, then I would actually be willing to bet on currency stability for these countries. In terms of some kind of a caution or preference, I would obviously be more cautious about the countries that have a very large export. Like Vietnam has 94% of its GDP in exports. Malaysia has, I think, close to 40% or so. Thailand is similar. So those are the ones I would be more cautious about.
Got it. We have another question here. Which sectors in ASEAN would in your opinion, would offer the best medium-term growth opportunities given the current macro backdrop?
All right. One obviously would have to look at number one, the domestic sectors, not the ones which are exporting in a big way, because the exporters would be under risk for some time. Second, what are the drivers of growth? And, if you think back, when we talked about the drivers of growth, these are predominantly private consumption because these are consumption-driven economies in the range of 55 to 75%. And some of the economies are actually focusing on investments in infrastructure, particularly transportation infrastructure in case of Thailand, Indonesia, or Philippines. So in those economies, in Indonesia, Thailand, Philippines, I would focus on the financials, which are possibly the best way to play a general broad-based economic recovery. It's also no coincidence that financials are also dominant sectors in these markets. It's about 33% of Indonesia, close to 47% of Philippines. So financials would definitely be one of my preferred areas in ASEAN. I would also look at selectively some of the digital economy participants and some of the materials in Indonesia, because the government policy is now aligned. They're trying to sort of enhance digital economy to a different status, about 15-20% of GDP. They're trying to go for this downstreaming, which is enhancing value of the raw materials before exporting. All this is a good sign for for those sectors.
Got it. I think we have time for just a couple more questions if we just, quickly get your take on this. So another question we have, Manishi, is which ASEAN index or indices would you say have the most upside from the current state?
Well, I mean, there are some of the there is an MSCI ASEAN index which is kind of representative of the entire ASEAN region. But if I were to play the individual markets, then I would definitely be focusing, number one, on the JCI, the Jakarta Composite Index. Over the long term, Indonesia has one of the strongest economic outlooks simply because it has an increasing working population. It has a degree of diversity in its economy. I would also be focusing on pockets of, say, Singapore and Malaysia, particularly when it comes to infrastructure and industrials. But if I were to look at just a single country index, my top preference would certainly be the Indonesian index, the JCI.
Noted. And we have one last question that we have time for. So that is, you mentioned ASEAN fixed income is likely to be safer or more stable in this environment. So is that USD denominated credits or local currency?
Right. Now, this is obviously in these markets, it's a local currency which tends to be relatively safe because whenever you're investing in USD denominated bonds, number one, we're facing the US dollar risk, the currency risk. And at the same time, it's one, the corporates which have raised these bonds, they have to have revenues, adequate revenues in that same currency, in US dollar, to be able to pay these back. So there are, additional layers of complications there. So if I were to play it safe, I would rather play the local currency market.
Got it. Thank you. I believe that's our time for today, Manishi. Thank you very much for your time and for the presentation. It was certainly very insightful. And thank you for all our attendees for attending this session live. If you wish to keep track of Manishi's work, we recommend following his profile on Smartkarma so you don't miss out on any of his insights. We have also shared a link for that in the chat to this Zoom session. Please also note that Manishi is available for bespoke research requests or premium services. So if you wish to engage him for that, please contact your Smartkarma account manager. Lastly, if you have any other questions or comments, you can reach out to us at research@smartkarma.com. That's it for today. Thank you, Manishi, and thank you everyone for attending. Have a great week ahead.
Thank you. Thank you very much. It's been a pleasure.
Thank you.